Right now, the global economy is that wave, and all the signs point to it cresting in 2026. For most, this looming financial tsunami spells disaster. But for a select few, it represents something entirely different, the single greatest wealth opportunity of a generation. This is why the 2026 stock market crash could be your biggest wealth opportunity. When the average person pictures a market crash, they see a monochrome newsreel of despair. They see shattered dreams, evaporated life savings, and the palpable fear of an uncertain future. This narrative is sold to us in history books and sensationalized media reports. It's a story of endings, but there's a second, quieter story that runs parallel to the chaos, a story they never tell you. It is the story of how every catastrophic collapse in market history has been followed by the most profound transfer of wealth ever witnessed. The skeletons of one financial era become the foundation for the next generation of fortunes. The numbers are not just compelling. They are irrefutable. Consider the investor who, amidst the suffocating gloom of the Great Depression, mustered the courage to buy shares of solid foundational companies. While others saw only ruin, they saw assets on sale for pennies. That patience was rewarded with returns that would dwarf the gains of modern tech IPOs. When the dot-com bubble imploded in the early 2000s, it vaporized trillions in speculative paper wealth. Yet, in the wreckage of failed pets and dubious tech startups, lay the beaten-down shares of companies that would become the titans of the new century. Those who saw the real value beneath the hype, who bought Amazon when it traded for little more than a fancy meal, or Apple when it was left for dead, watched their foresight multiply 100-fold. The 2008 financial crisis felt like the end of the world. Banks failed, credit froze. The very architecture of global finance cracked. But that crisis was not an end. It was a brutal, necessary reset. It was the beginning of the longest bull market in American history. The families who lost their homes to foreclosure were tragic casualties. But simultaneously, disciplined investors with liquidity were acquiring prime real estate for 30 cents on the dollar. They were accumulating shares of world-class corporations at fire sale prices. The panic of the masses was the profit engine for the prepared. We are now standing at a similar precipice. The warning signals are no longer faint blips on a radar. They are screaming alarms across every credible economic metric. This isn't about a mere 10% correction. This is about a fundamental reset of a system strained to its breaking point. The critical question for you is not if you will weather this storm. The truly life-changing question is, will you be positioned to profit from it? The secret that the financial establishment doesn't want you to understand is deceptively simple. Market crashes do not destroy wealth. Not truly. What they do is transfer it. They violently wrench assets from the hands of the emotionally unprepared and deliver them directly into the portfolios of the rational and patient. They move capital from those who operate on fear and speculation to those who operate on logic and a plan. If you can decipher the patterns unfolding beneath the surface, you can place yourself on the winning side of this historic transfer. Let's begin with the economic rhythm that has dictated American prosperity for over a century. It's a predictable, almost metronomic cycle. Roughly every 18 to 20 years, the system reaches a climax of excess. Debt, unchecked speculation, and artificial prosperity collide with the unyielding laws of mathematics. We witnessed this in the Roaring Twenties before the 1929 collapse. We saw it in the stagflationary crisis of the 1970s. It echoed in the dot-com mania of 2000 and the housing bubble of 2008. The clock is ticking, and as we approach 2026, every reliable indicator suggests the next great reset is imminent. Look at the evidence. The cyclically adjusted price-to-earnings (CAPE ratio), which measures whether the stock market is overvalued or undervalued, is currently flashing a deep warning red. It's at its second highest level in recorded history. The only time it was higher? The precise peak before the dot-com crash that wiped out a generation of speculative investors. Meanwhile, consumer debt has ballooned to levels that would have been incomprehensible to our parents. Households are leveraged to the hilt, sustained by credit cards and loans that assume the good times will never end. Corporate America is not immune. For years, companies gorged themselves on historically cheap debt, using it for stock buybacks and expansion. But now, as interest rates rise, that very debt is transforming from a strategic tool into a crushing burden. Their balance sheets, once praised, are now looking increasingly fragile, and underpinning it all, government spending has entered a realm of pure fantasy, with deficits so large that even the architects of the system are quietly whispering about sustainability. Yet, what is the chorus from the mainstream financial media and many institutional economists? Don't worry, the economy is strong. This time is different. These are the same siren songs they sang in 1999 and again in 2007. They were catastrophically, tragically wrong. While this comforting narrative is broadcast to the public, the so-called smart money is executing a quiet, deliberate retreat. Warren Buffett's Berkshire Hathaway is sitting on a war chest of over $150 billion in cash, a record high. This is not a sign of timidness. It is the ultimate sign of anticipation. It is the chess master quietly positioning his pieces before the opponent even realizes the game has changed. The stage is set, the debt is piled high, the optimism is pervasive, and the warning lights are flashing. But this is only the surface-level diagnosis. To understand the true opportunity, you must look deeper into the very mechanics of how wealth is silently being moved before the first domino even falls. What happens next will change everything you think you know about how the wealthy prepare for chaos. The anatomy of a wealth transfer. While the majority of investors sleepwalk toward the cliff's edge, a deliberate and calculated migration of capital is already underway. This isn't a panicked run for the exits. It's a strategic repositioning. Major hedge funds are building significant defensive positions, quietly accumulating assets like precious metals and other historical stores of value. Institutional investors are slowly, methodically, rotating out of the most overvalued, speculative growth stocks and into companies with fortress-like balance sheets and reliable cash flows. They are not predicting the future with certainty. They are preparing for probability based on the immutable patterns of history. The official forecasts seem almost deliberately placating. Some economists point to a projected rise in the unemployment rate, suggesting a mild cooling. Others place the odds of a recession at a manageable 40%. But history has shown that these same experts have a perfect record of failure when it comes to predicting the timing and severity of major downturns. The real probability. When you filter out the noise and look at the convergence of debt cycles, valuation extremes and monetary tightening is far more alarming. On the ground, the early tremors are already being felt. Manufacturing sectors are beginning to contract. Consumer confidence, that fragile pillar of a consumption-driven economy, is starting to crack under the weight of inflation and soaring credit card balances. Defaults on auto loans and credit cards are creeping upward. And perhaps most ominously, the commercial real estate market, laden with debt and struggling with the new reality of remote work, is showing signs of profound stress. These are not abstract data points on a chart. They are the early warning signals of the financial earthquake building beneath our feet. This is where a critical psychological divide emerges. The chasm that separates the perpetually wealthy from everyone else. The average person sees a crisis as a threat. The strategic investor sees it as a necessary cleansing, a forest fire that clears the deadwood and allows new, stronger growth to emerge. They understand that crashes are not random acts of God. They are systematic, almost mechanical, transfers of assets from weak hands to strong hands. Think of it as a colossal, involuntary garage sale. The weak hands are those who bought assets with excessive debt, who chased speculative fads, who have no cash reserves. When the economy turns, they are forced to sell their possessions, their stocks, their real estate, their businesses to survive. The strong hands are those who lived below their means, who saved diligently, who avoided the seduction of easy leverage. They are the ones with the cash to show up at that garage sale and buy valuable assets for a fraction of their true worth. The 2008 financial crisis was a masterclass in this phenomenon, as millions were forced into foreclosure. A small cohort of investors, with liquidity, acquired residential and commercial properties at discounts of 50, 60, even 70%. They weren't just buying buildings. They were buying cash-flowing assets at prices that guaranteed generational returns. They weren't luckier. They were more prepared. They saw the same carnage but processed it through a different lens, a lens of opportunity, not victimhood. This pattern is a historical constant. During the depths of the Great Depression, the legendary investor John D. Rockefeller was said to have calmly stated, "These are the days when the wealthy are made." While breadlines stretched for blocks and despair was the national mood, those with capital and vision were acquiring stakes in the foundational industries of the 20th century: oil, steel, railroads at prices that would never be seen again. They understood that the intrinsic value of a productive asset doesn't disappear during a panic. Its price simply becomes disconnected from its worth. The core insight is this: crashes are not random. They are the inevitable conclusion to a predictable cycle driven by the twin engines of human psychology and mathematical reality. Periods of easy money and irrational exuberance always, without exception, end the same way. Debt that seemed manageable during the boom becomes unpayable during the bust. Asset prices justified by new paradigms come crashing back to earth, reverting to their historical means with violent speed. And this is precisely the cocktail we are drinking today. We are living through the greatest expansion of debt in human history. Corporate debt makes the pre-2008 levels look conservative. Government deficits are spiraling into a void, threatening the very credibility of the world's reserve currency. This debt mountain has been used to inflate asset prices to dizzying heights through over a decade of near-zero interest rates and quantitative easing, a form of money printing on a scale that would have been unimaginable just a generation ago. The result? A stock market where prices have become utterly divorced from the underlying earnings of the companies they represent. A real estate market in many cities where ownership is a fading dream for an entire generation. A bond market propped up by the assumption that governments will never, ever fail to pay their bills. But mathematics is a merciless and unforgiving master. It does not care about assumptions, hopes, or new paradigms. Rising interest rates are now piercing this fantasy. The cost of servicing all that debt is exploding, consuming ever larger portions of corporate profits and government budgets. Consumer spending, the last engine of growth, is sputtering as credit limits are maxed out, and the reality of monthly payments sets in. The stage is not just set for a correction. It is set for a reckoning. Understanding the cycle is one thing, but knowing how to position yourself within it is where theory meets life-changing practice. The coming storm will separate the real from the illusory, and your actions in the next few months will determine which side of the wealth transfer you ray on, and this is where the video takes a shocking turn, revealing the precise psychological and strategic blueprint you need to follow. The prepared mind, your blueprint for the chaos. The single greatest mistake you can make right now is to assume your current financial strategy is adequate. For most people, their investment psychology has been conditioned by a multi-decade bull market. They are trained to think like consumers, not capital allocators. They buy when prices are high and headlines are euphoric. And they sell in a panic when prices are low and the news is terrifying. This instinctual, herd-like behavior is a guaranteed recipe for being on the losing side of the wealth transfer. To succeed, you must perform a complete inversion of your natural impulses. When your coworkers are bragging about their portfolio returns and talking about retiring early, that is not your signal to join the party. That is your signal to become cautious. That is the time to build your cash reserves, to reduce your exposure to the most speculative assets, to prepare your financial bunker for the coming storm. Conversely, when the crash arrives and the financial media is saturated with images of despair and predictions of a new dark age, that is not your signal to hide? That is the moment for which you have been preparing. That is when generational fortunes are patiently built. The wealthy internalize this principle because their wealth is built on the lessons of history, not the emotions of the moment. They know that maximum financial fear creates the most asymmetric investment opportunities of a lifetime. They understand that when the crowd is gripped by a desperate need to sell at any price, you can acquire pieces of the world's best companies at prices that seem like a typo. In this environment, cash is not merely a safe haven. It is a strategic weapon, but its power is often misunderstood. The purpose of accumulating cash is not for preservation alone. Its true value is as dry powder as purchasing power that can be deployed when everyone else is financially paralyzed. The investors who patiently built their cash positions in 2006 and 2007 were not missing out. They were arming themselves when 2008 hit. That cash became a golden ticket to buy real estate, stocks, and entire businesses at valuations that created dynastic wealth. However, cash alone is a blunt instrument. You must couple it with the wisdom to discern what is truly valuable. In a storm, you don't want to own a house of cards. You want to own a fortress. History consistently shows that quality always survives and ultimately thrives. What is quality? It is companies with impenetrable balance sheets, little debt, and massive cash flows. It is businesses that provide essential goods and services that people cannot live without, even in a recession. These entities don't just endure the downturn. They use it to their advantage, acquiring weaker competitors, stealing market share, and emerging from the chaos more dominant than ever. The same logic applies to real estate, but with a critical caveat. Not all property is created equal. Prime, well-located real estate in areas with enduring demand may see its price decline temporarily, but its fundamental utility and scarcity remain. It will recover. Meanwhile, speculative developments in the middle of nowhere or commercial properties built for a pre-remote work era can see their value evaporate completely. The key is to identify assets that possess intrinsic, durable value that transcends economic cycles. Precious metals like gold and silver play a specific role, but it is often mischaracterized. They are not typically get-rich-quick speculation vehicles. They are, instead, the ultimate insurance policy against a systemic breakdown. They are wealth preservation tools that have maintained purchasing power for thousands of years, especially when faith in paper currencies and financial institutions erodes. They are a hedge against the very worst-case scenario. The timing of your strategy is everything. Beginning to prepare after the crash has begun is like trying to buy flood insurance while your basement is already underwater. The real opportunities are created now. During this final act of the boom, this is when you must be building your cash position, conducting deep research on quality companies you'd love to own at a 50% discount, and mentally fortifying yourself for the volatility ahead. A powerful technique to employ during the downturn is a dynamic form of dollar-cost averaging. Instead of investing a fixed amount blindly each month, you invert the strategy. You invest smaller amounts when markets are high and euphoric, and you dramatically increase your investments as markets fall and fear peaks. This forces you to be greedy when others are fearful, systematically buying more shares of quality assets at lower and lower prices. The psychological battle will be the hardest part. Your environment will scream at you to do the opposite of what is rational. During the run-up, friends will mock your caution. During the crash, those same people will tell you it's insane to invest. Your own gut will clench, telling you to wait for stability and certainty. But you must remember, certainty is the most expensive commodity in the market. By the time it feels safe to invest, the once-in-a-lifetime bargains will be long gone. This blueprint prepares you for the storm, but it only tells half the story. The final piece of the puzzle involves understanding the larger, more sinister game being played by central banks and governments. A game that will determine the ultimate winners and losers in the new financial world order. Most people never hear the next part, and that's the real danger that could wipe out even the most careful plans. The Grand Reset and your place in the new world. The infrastructure for the next great wealth transfer is not being built on Wall Street trading floors alone. It is being constructed in the marble halls of central banks and finance ministries around the world. While public attention is focused on AI and electric vehicles, a silent revolution is occurring within the global monetary system itself. Central banks are maneuvering for a reset that will make the 2008 bailouts look like a minor rehearsal. Consider the sheer scale of the intervention. The U.S. Federal Reserve's balance sheet has exploded from under $900 billion before 2008 to a staggering $9 trillion today. We have witnessed experiments with negative interest rates in Europe and Japan, a bizarre financial reality where lenders effectively pay borrowers to take their money. These are not temporary measures. They are permanent life support systems for an economic patient that can no longer breathe on its own. This artificial support, however, has a finite limit. We are rapidly approaching it. The world is now saturated with zombie companies' businesses that are only alive because of artificially cheap credit. They should have failed years ago, but their continued existence prevents the healthy creative destruction that purges the economy of inefficiency and makes room for true innovation. The entire system is being choked by this financial deadwood. The underlying mathematics are brutal and simple. When the growth of debt consistently outpaces the economy's ability to generate real growth to service that debt, the system must break. It faces two painful choices, both of which result in a massive transfer of wealth. The first path is currency debasement. Here, governments and central banks choose inflation. They print money to pay off debts, effectively making each unit of currency less valuable. This is a silent, insidious tax on anyone who holds cash or fixed income assets like bonds. It rewards debtors and punishes savers. Who wins? Those who own real, tangible assets, real estate, productive land, shares in thriving businesses, and precious metals. These things cannot be printed, so their price in the debased currency naturally rises. The second path is default and deflation. This is the 2008 scenario. Debtors simply cannot pay, leading to a chain reaction of bankruptcies and fire sales. Lenders are wiped out, and assets are liquidated for pennies. Who wins? Those who held cash through the deflationary storm. As its purchasing power skyrockets relative to the collapsing prices of assets. Our current system is a dangerous hybrid, threatening us with the worst of both worlds. We are experiencing the slow burn erosion of purchasing power through inflation, while also building toward an acute crisis of defaults when the debt bubble can no longer be sustained. The smart money navigates this by borrowing wisely to acquire real assets, profiting from inflation, while simultaneously building a cash war chest to acquire defaulted assets during the deflationary crash. This crisis also has a profound geographic dimension. Economic disasters are never evenly distributed. The coming turmoil will create havens and hellscapes across the globe. Holding assets in strong currencies while potentially living in a country with a weakening currency can be a powerful shield. Investing in nations with strong balance sheets, energy independence, and political stability will be crucial. Beyond finance, true preparation extends to your personal ecosystem. In a crisis, your skills become your most valuable currency. Being adaptable, having a trade, or possessing knowledge that remains in demand regardless of the economic weather is a form of insurance no government can inflate away. Your health is a financial asset. Your network of trusted relationships becomes a safety net stronger than any government program, reducing your dependencies on fragile supply chains, on expensive, centralized energy. On a single source of income is how you build resilience. The final and most powerful concept is the mathematics of compounding through crisis. Buying a quality asset at a 70% discount and watching it return to its fair value isn't a 70% gain, it is a 333% return. These are the returns that reshape family trees. But the true magic happens when you reinvest those crisis-generated gains into the subsequent recovery. The investors who bought in the depths of 2009 and held through the following decade didn't just make money. They built foundations of wealth that will last for generations. History does not repeat itself verbatim, but its rhythms are unmistakable. The financial reset approaching in 2026 is not a monster lurking in the shadows to devour your future. It is a force of economic nature, a tidal wave of change. For the unprepared, it will be devastating. But for those with the clarity to see the pattern, the discipline to prepare, and the courage to act when fear is at its peak, it represents something else entirely. It is the opportunity of a lifetime. The question is no longer what is coming. The question is, who will you be when it arrives? The victim caught in the storm? Or the architect, building a new future from the pieces left behind? The wave is building. What you do now, in these quiet moments before it breaks, will determine everything.